So welcome all for the second Finance Grand Challenge series talk. This is going to be a fascinating one on digital assets and fintech. It's my very favorite topic until generative AI took over last year. Last time we had a very fascinating event. This whole auditorium was full. It was on the exploding deficit and the debt and the consequence of that. We learned a very interesting lesson that many of them keep telling me is the same debt to GDP ratio that existed after World War II, that same generation paid it back. For the first time, sorry, we are leaving it to you to pay back. And our Professor Mike Faulkender will tell you that may not happen even in your generation. So it's going to be a very troubling. But this whole idea to bring you these kinds of topics for you young people to understand the difficult environment you might get in, and you're going to ask some difficult questions. And we're going to have a very civil conversation about these difficult topics. Today's topic is about digital assets and fintech. Pretty much anything today can be made into digital assets, whether it's video, your family portrait, if you want, if it has value, especially if you come from, say, John F. Kennedy's family and you want to have a family photograph, and you can even digitize it and make it into a non-fungible token and monetize it. I would suggest that you look at an article in Wall Street Journal by Phil Graham, former senator and a presidential candidate at one time. He with an economist, Hernando de Soto, who wrote a very fascinating book on why it's called The Mystery of Capitalism, why it thrives in the West and fails elsewhere. And that article is about blockchain. And this today's talk is about three major things, is ideas. The idea is about a very fascinating technology called blockchain. It's about digital assets in the broader scheme of things, and also about cryptocurrency and all the innovation that might come after that. These are really great concepts. One of the things that excites me is the underlying technology, the blockchain itself. And the article that I'm referring to is Phil Graham and Hernando de Soto wrote an article that's saying in Wall Street Journal how blockchain can eliminate poverty. And you wonder, what's blockchain got to do with poverty? People have tried to solve it for centuries and they've never been able to address it in a meaningful way. It's about property rights and how you can monetize your property rights. And there are a lot of exciting things going on today in Africa. If you see how a supply chain works from a farm in Africa to Starbucks or Walmart, bulk of the benefits of those things actually goes to the middlemen intermediaries in between, not to the farmers themselves. So there's a lot of exciting things going on. Is how do you make this poor farmer in Africa reach Starbucks directly and capture all the benefits than somebody else in between? And that's how you solve poverty. So there are a lot of exciting things. So today, we're going to talk about digital assets and a lot of exciting things going on in New York, even with building properties. You tokenize them and democratize owning properties in New York, even if you don't have much income. So exciting things going on in the world. The one is about cryptocurrency. And there's a lot of debate. Charlie Munger, who passed away recently, said the underlying value is zero. Jamie Dimon, JP Morgan CEO came and said, what is this? A lot of people question what it is. Today, Bitcoin just hit all-time high. I think yesterday it fell, crossed $2 trillion once more. Things are happening, whether you believe it or not. There may be a lot of innovations that might happen around these things, which we cannot foresee. That's why we need entrepreneurs who exploit these things. And I was looking at some of the board of many of these companies. A large fraction of them are lawyers, not technologists, because it's not a technology issue. You'll see it. So a lot of exciting things going on. I would like you to ask lots of good questions. Can you really have transactions with Bitcoin? We don't know, because how do you execute several thousands of transactions in a second? What kind of regulations will come and enable or derail these things? What innovations might come up with digital assets and fintech itself is up in air. But we do know that there are some very difficult questions And today's talk, we have speakers who also talk about creating an entire infrastructure to manage this. Anybody look at data, all the mining infrastructure? Those are fascinating. It also consumes massive amounts of power. So lots of difficult questions. So today's discussion is about those things, and hopefully it'll ask more exciting questions than what I raised here. And to host this event today is our fantastic, awesome faculty, Dr. Michael Faulkender. And I want to briefly introduce him. He has been here at University of Maryland since 2008. He was Associate Dean for the Master's Program. And in 2019, he joined the US Department of Treasury as the Assistant Secretary of Economic Policy. So nobody would have missed the PPP, the Paycheck Protection Program. And that whole program, to a large extent, Dr. Faulkender was able to make it. I always keep forgetting, it's 300 billion or 600 billion in a week?
We did $350 billion in
13 days. And that stopped the collapse of the economy because the jobs were being shedded like crazy every day during the pandemic. In January 2021, he was awarded the Alexander Hamilton Award for Distinguished Leadership, the highest service award granted by the Department of the Treasury. His research lies at the intersection of financial economics and public policy. Examples include the job impacts of PPP, corporate capital structure, corporate liquidity, and executive compensation. His work has been published in top academic finance journals, received numerous best paper awards, and has been cited in the Wall Street Journal, Washington Post, and New York Times. Actually, not cited. He's pretty much there every day somewhere. He has testified in Congress 6 times, and I personally like engaging with him because he has data, he has insights in today's problem that you see with inflation. I always call it human-made inflation. I think you agree with that. He has also written numerous op-eds in Wall Street Journal, Baltimore Sun, Washington Times, as well as regularly appearing on Fox Business, CNBC, and other places. Let me hand it over to Professor Mark Faulkender to introduce our guest speakers, and it is yours.
All right. Thank you, Prabhadev. Let me welcome all of you to this evening's event. As the Dean mentioned, we're going to be talking about fintech, digital assets, and essentially the evolution of the payment system. Before I dive into those topics, though, let me, as the Dean indicated, introduce our guests, who, yes, both of them are lawyers. First, I have Heath Tarbert. Heath is the Chief Legal Officer and Head of Corporate Affairs at Circle, which is a global fintech firm that enables businesses of all sizes to harness the power of stablecoins and public blockchains. Prior to joining Circle, he was the Chief Legal Officer at Citadel and previously served as the Chairman and Chief Executive of the Commodity Future Trading Commission, and prior to that was also an Assistant Secretary of the Treasury for International Markets and Development. Heath has also served as a Supreme Court law clerk, Associate White House Counsel, Special Counsel to the Senate Banking Committee, and a partner at 2 international law firms. He is likewise a recipient of the Alexander Hamilton Award and the Secretary of Defense Medal for Outstanding Public Service and the Freedom of the City of London for strengthening financial regulatory relations between the United States and the United Kingdom. Heath earned his bachelor's degrees from Mount St. Mary's University. He is a Maryland native. His law degree from Penn and his Doctor of Philosophy and Comparative Law from Oxford. Brian Morgenstern is also joining us. Brian joined Riot in January 2023 as the company's head of public policy, responsible for leading their advocacy efforts at the state and federal level regarding legislative and regulatory issues in the areas of energy, environment, financial services, tax, and national security. Brian previously served as the White House Deputy Press Secretary, Deputy Communications Director, Special Assistant to the President in 2020 and 2021. Prior to that, he was my next door neighbor at Treasury, where he was the Deputy Assistant Secretary and Chief Speechwriter to the Secretary of the Treasury. Brian played an instrumental role in the implementation of legislation, including the Tax Cuts and Jobs Act, the CARES Act during the pandemic, and FIRMA. From 2010 to 2017, he practiced law at a large global law firm in New York, handling litigation as well as white-collar and regulatory investigations. Earlier in his career, he worked on Capitol Hill for the House Committee on Natural Resources He earned his bachelor's degree in government from Georgetown and his law degree from Columbia Law School. So please help me in welcoming our guests this evening to the university. What I thought I would do to get us started is give you a little bit of background, just to kind of set the table for those of you that have never really thought about the payment system or even the role of money, right? Because if we're going to start talking about making trades and exchanges different than the way we do it now, we have to first ask the question, what is the role of money in society? What are its features that we're looking for? What are some of the problems with the current system that we use, and how might cryptocurrencies, how might moving more in a technological direction on financial issues, might we improve the lives of everyday Americans, right? And so the first thing you have to ask is, what is the role of money, right? And so the way that we have thought about it as economists is essentially money serves two purposes. Number one, it facilitates exchange, right? So for the most part, we do not cook our own, we do not grow our own food, we do not build our own houses, we don't build our own cars. We are specialists in an economy. We do one thing really well. We get paid money, and then we use that money to then buy goods and services. So it facilitates exchange rather than each of us doing a little bit of work for the farmer or a little bit of work for the clothing maker, a little bit of work for the house builder. We do one thing for customers that get the most value from us, and then we get this thing that we can use everywhere else to engage in purchases, right? So the first thing you want money to do is facilitate trade. The second thing is that it stores value in the interim. When I work is not necessarily when I'm going to consume. Between when I'm paid and when I spend the money, I need it to store value in the interim. I can't have it be something that I'm able to use it today and it's gone a week from now, or it has no value a week from now, right? So when we think about viable substitutes for dollars and why we might want to move away from dollars, the first thing we have to start with is, how is it going to better facilitate exchange, and why is it a better store of value in the interim, right? And so the thing about money is, as we think about substitutes, we also have to ask is, where does its value derive from? Okay, so does money serve any intrinsic purpose other than facilitating exchange and in the interim storing value? Okay. Back when we used gold as a means of exchange, gold has an intrinsic value. You can do other things with it. You can wear it. It has technological, industrial applications. It has other purposes merely than facilitating exchange and being a store of value in the interim. Arguably, dollar bills don't perform that function, right? Can't really do anything else with them. I mean, I guess if you push it to an extreme, you could burn them as a source of fuel, right? But as former Treasury officials, all of us have to tell you that that's not legal, right? Is it backed by anything? No, it used to be, but we went off the gold standard. So you cannot force exchange into something that otherwise has value, right? So you can no longer go to the Treasury Department or go to another agency of the government and say, give me something else in exchange for it. It has no backing. So the question is, if it has no other intrinsic purpose and it's not backed by anything, why do people nevertheless use it? And essentially the answer is, well, because I think people are going to still use it tomorrow. It has value today because it's going to have value tomorrow. It'll have value tomorrow because it'll have value the next day. As long as we all continue to believe that others will take it from us, it will continue to have value. So what that means is that if there were to be a crisis of confidence in a currency, then it can lose its value very quickly because it otherwise has no purpose, right? And so as we think about substitutes, as we think about the underlying core value of a cryptocurrency, let's ask ourselves those kinds of questions, right? Now, we've been evolving the payment system ever since people were exchanging with each other, right? So as I mentioned before, you started out by bartering, making exchanges with each other, good for good or good for service. But then we decided, let's actually have some kind of intermediary. And so gold was the first one. We then have now paper currency. But most of us, probably most of you who are under 25 in this room carry almost zero paper currency with you, right? So paper currency still exists, but most of us don't exchange in it anymore. We went to checks for a while. One of the benefits of them is because if your wallet is stolen, the money is gone. If your checkbook is stolen, You just cancel the checks. The money is still there. So it's a safer means of exchange. That's one of the reasons that you might go for one means of exchange over another, is because there's a layer of security. Right? So we want to talk about, how do these alternatives to paper dollars, how do digital assets maybe provide that? Okay. The problem with checks is there's no guarantee for the merchant. When I write a check to the grocery store cannot put a claim on my bank account ensuring that the money will actually be there. If I instead use a credit card or a debit card, that payment is guaranteed. There's a block put on that money at the bank, if it's a debit card, to make sure that the vendor actually gets paid. So it's more secure for the seller in that case. So that was why we had that evolution. Right now, as we've done more and more of our purchasing activity in online forums, to the extent you want to make purchases from far away, we want to be able to facilitate online payments. And so that's been another revolution that has taken place. Now, in some parts of the world, you've seen this movement towards cell phones. Okay. So as Prabhadev was mentioning earlier, if you go to the developing world, you don't see a lot of banks. And so if you think about all of these prior means of exchange, there's a bank behind it. There's a bank against which the check is drawn. There is a bank that's satisfying either the credit or the debit card transaction. Okay. A lot of people in the developing world do not have bank accounts, but you know what they do have? They have cell phones. There are cell phone towers all over the place. And so imagine if for a moment, instead of a bank being the financial intermediary, what if the cell phone company became the financial intermediary, and you essentially had credits on your cell phone, and that was what you transacted with, right? And so it makes sense for bank-dependent areas of the world to be in this debit credit card space, which is the primary form of payment we have here in the United States. But in the developing world that's largely not banked, then you're going to need a substitute for it. And that's where you've seen the whole phone banking applications really take off. And now we're at the stage of cryptocurrencies, right? And so one of the fundamental questions we have, we're gonna make the use case question. Why is it, what are the deficiencies in the current system such that people, either individual consumers or merchants, are going to prefer to move to something like a cryptocurrency? What are some of the attributes that it offers that are going to be an improvement, again, either as a store of value or a means of exchange? Okay. So as I mentioned before, if you currently look at the way people pay for things, it's primarily through credit and debit cards. They're on the rise, checks are on the decline, and very few people, as I mentioned, are really using much in terms of currency these days. All right, so that kind of gives you an idea of the current baseline of the payment system. Okay. Now, some people think fintech, this is this new word that's been created, that applying technology to financial services is somehow novel. It's not, right? We've been taking technology and updating the payment system for decades, right? So wire transfers have existed for decades that allows you to move money around the world electronically. ATMs came out in the 70s and 80s that allowed you to get access to money without going to a bank during banking hours. Payment systems, right? So online payment systems, online banking applications. Those are applications of technology to help improve access and management of people's money. What is it that's different now? Well, the big thing that's changed is almost always what happened in the past is that banks obtained these technologies, and it was still the banks at the lead of the financial system. What's potentially different now is you see non-banks coming in and potentially substituting for banks at the center of the financial system. And again, that's one of the evolutions we're going to talk about, particularly from a regulatory standpoint. Banks are highly regulated. If technology companies now become the heart of the financial system rather than banks, what does that mean for the entire financial architecture from a regulatory standpoint, right? So those are some of the things that we're going to want to think about. Now, underlying some of this technology are the blockchain, which again, the dean is going to be able to tell you a lot more about than I can. I'm kind of the financial economist at this, but the whole idea is that right now, if I use my credit card, it's my credit card company who keeps a ledger of my transactions, right? And so if I wanted to engage in fraud, I need to merely hack my credit card company, right? And change the ledger. Okay, now, the benefit of a blockchain is that rather than that ledger being stored in a single location, it's stored in multiple locations. And so what you would have to do in order to engage in fraud is you'd have to simultaneously hack multiple ledgers and update a majority of them in order to alter how much money you owe or how much money's in your bank account or whatever the system is, right? So the whole idea is that by having multiple ledgers that are all simultaneous and that are guarded by cryptographic technology, then perhaps that's a more secure payment system than having a single ledger type of system, right? And so that's one of the attributes that we can think about as what the blockchain does. Now, again, the blockchain technology is different than the payment system. So again, one of the things we're going to want to talk about is, do you need the blockchain to be denominated in its own currency or in its own units? Or can we somehow do that through US dollar backed stable coins? What is the equilibrium type of use case that emerges there? Right, so these are all of the types of exciting issues, but I wanted to at least kind of set a baseline for how the different aspects of this and how we're going to have a lens to approach it through. So with that, let me hand it over to Heath, who's going to give you kind of his sense on things from his perspective.
Terrific. It's great to be back here at College Park. As a young man, a young boy, I would come to games in Cole Fieldhouse, and family members went here, so it's great to be back. I think I will pick up where you left off, which is ultimately, we know that at least there is one form of currency that everyone uses right now today, and it's called the US dollar. So an initial question for crypto use cases, can we actually put the dollar itself onto blockchains? Can we actually have a digital dollar, a truly digital dollar? And then that may very well lead to additional sort of developments, including other types of digital assets and cryptocurrencies. But even if you want to buy something like a Bitcoin or Ether, you've got to pay right now in dollars, right, for the most part. So the question is it possible to actually just digitalize the dollar as an initial use case for crypto and the digital asset system so we can help that evolution? Well, the question I'm going to ask is, well, what's a digital dollar? But before I do that, I'm actually going to ask, what's a dollar? Now, of course, you guys are like, well, you know what a dollar is, right? But the dollar's changed over the years. It's no longer backed by gold. It's no longer necessarily pegged to anything. But let me just ask a very simple question. Who issues dollars? Where do dollars come from? Just somebody. The Federal Reserve, of course. When you whip out your wallet, for those of you that actually have paper money, which may not be anybody, it says Federal Reserve note. But here's the interesting thing, right? And you can correct me if I'm wrong, because I have an esteemed economist here with me, but basically Federal Reserve money, so actual physical money, but also money that is sort of issued to banks from the Federal Reserve, we call that M0. That's our base layer of money. And that's about $1 trillion. The actual money supply, which comprises M1 and M2, is about 22 trillion or so dollars. And that's money from banks. So in other words, what happens is the initial dollars go to a bank. The bank then keeps some of that in reserve, and it puts out loans. So our money supply, all the dollars out there, the 95% of it is sort of bank money. They're Citibank dollars, they're Bank of America dollars. So that's just something to keep in mind, that our current monetary system is based on something called the fractional reserve banking system. That can be really shaky, because if depositors come and immediately want all their deposits back, those deposits are in loans, they're out there, they're not readily on demand. So the solution to that, the government has come up with, is deposit insurance on the one hand and federal discount window access on the other. Just going to put a pin in that because it's important before we even talk about what's a dollar or what's a digital dollar is dollars themselves. And that issue about the fractional reserve banking system and who actually issues the dollar plays into our questions about how are we going to have a digital dollar. So to go to sort of, I would call this a first generation digital dollars. And so some people have said, well, the dollar is digital, right? You guys have phones, you have computers, dollars are digital. But really, I'd say there are 3 generations. The first is a picture of the SWIFT system. That was back in the day where essentially you had centralized communications. So the bankers were talking to themselves. You weren't talking to anyone. And the ledgers were centralized. It was banks talking to banks and making changes on their ledgers. Their ledgers were on computers at some point, so technically they were digital dollars, but that's not what we're talking about here. The second generation digital dollars occurred when the internet came out, right? And so now you actually have everyone communicating with everyone via their phone. How many people have a Zelle or one of those attributes? So a bunch of people, right? So you're able to communicate immediately with other people, but you're not actually sending value itself over that. What you're doing is you're communicating through a closed bank network that is sitting behind it all, actually doing the debits and the credits. So here we have decentralized communications with centralized ledgers. So you can probably guess what the third generation is going to be, which is something like USDC, which is the coin that Circle issues. It could be on something like Ethereum. And the radical change with blockchain technology is we have the same decentralized communications over the internet, but we no longer have those centralized participants. So essentially what the blockchain technology enables you to do is take out these big, large financial institutions out from the middle of everything and to actually send value as easy as you're sending an email. Without friction, immediately, instantaneously. And we can get into all the technical reasons what makes it happen, but that's essentially why, how we have sort of come to this stage. That's the revolution. So let me just tell you quickly about, there are three types of digital dollars. And I think I'm having some technical issues at this point. There we are. The first type is something called central bank digital currency. Have people heard about this? Very simple. This is M0. This is the Fed issuing a digital dollar. Second type would be tokenized deposits. Remember how I talked about the fractional reserve banking system? This is basically, you take all those bank deposits everywhere in America and you tokenize them and make them available on a blockchain. And then finally, there are stable coins, which at this point in time is the only digital dollar that currently exists. This is where basically you issue a digital amount of something, but in this case, we'll call it a dollar, that is basically pegged to the value of the dollar. It always stays as a dollar. The issue there is the quality of stable coins can vary. Some stable coins aren't that stable, but ultimately, if you have it backed 100% by something, the goal is that it will be valuable and continue to be that value. And therefore, you can physically represent a dollar on the blockchain. So what are the pros and cons? Let's start with central bank digital currency. It's digital-based money, no questions asked. In other words, the Fed is issuing it, so no one's going to be like, is that really a dollar? The Fed is issuing it, right? AML, that stands for anti-money laundering, counterterrorism financing, right? We're worried about that, but the government's issuing it. Maybe there's the possibility of a wholesale option because what is everybody in this room probably worried about? A dollar issued by the government, right? The government can essentially track every single thing you're doing, every purchase. There's a lot of concerns out there that it can even stop transactions and things that they don't want you necessarily transacting in. So this has become very controversial. Right now, it's really theoretical. There is no CBDC. There's been some research papers on it, but we're probably decades from that, assuming there's even public policy agreement that it makes sense. There's a risk to private lending. If the government, remember how our banking system works in the fractional reserve system, if the central bank is the only thing issuing money, what's going to happen to our banking system, right? Is that going to disintermediate, big economic word, our banking system? People are worried about that. It's a massive cybersecurity risk, right? How does monetary policy work if the Fed can triple and double the money supply with literally the stroke of a key? Unlike kind of the open market operations and the kind of stuff that the Fed does today. And then, of course, there's privacy, right? Government tracking everything. And we have a real world example of this. China has a central bank digital currency. Russia is developing its own. And some would argue that the real purpose of these currencies, apart from to advance technology, is actually to monitor their citizens, what they're buying, what they're selling, and to give them a good citizenship score. So interestingly enough, this sounds pretty dry and boring, but it's now become part of presidential politics. Donald Trump has come out and said, under no circumstances will we ever have a CBDC. The Biden administration is going to have to come up with its own position, but this is actually becoming what may seem like dry economic talk is actually going to be becoming more and more important. You're going to be reading about it in the papers if you aren't already. The second type is the tokenized deposits. Really quickly here, they're issued by banks. Banks are regulated. That's really good. We've got on and off ramps with regular dollars. We've got AML, CTFs, anti-money laundering rules already apply. There's some privacy, but what's the problem with what are the cons with tokenized deposits? Well, think about banks. Think about Silicon Valley Bank, the run on Silicon Valley Bank, banks collapsing. The FDIC can close a bank over a weekend. They've got time to go in, but if things can literally move deposits at a fraction of a second, what is that going to do to our banking system that's highly leveraged? Imagine that, and now apply it to the largest, biggest financial institutions in the country, right? The too big to fail banks. Are we even going to see even larger banks? There's a lack of financial inclusion, which the dean and professor talked about, which is really critical. A ton of people don't have access to banks. So if they don't have access to banks and the only digital dollars from banks, that doesn't really help that situation. It's not base money, and at the end of the day, it's still a closed network. It's still the banks talking to banks, largely. So those are the pros and cons of tokenized deposits. And then finally, the last slide is about stable coins. Here, you've got the open networks, you've got the scale, you've got a lot more computing power because you're harnessing the blockchain. When you harness the blockchain, you're not just using a single institution's computer systems, right? A centralized institution. You're using all the computer systems that are basically doing whatever mathematics and cryptography need to break the code to do the blockchain. There's no fractional reserves, unlike the traditional banking system. Stable coins, if they're well regulated, are one-to-one. Effectively, there's financial inclusion, so people can use their phones. You don't need to have a bank account. It's cutting edge because you can put it on DeFi and other stuff that maybe we'll talk about in a minute. And there's more privacy. And then finally, I would say, what do we have to worry about with stable coins? Not all stable coins are equal. Right now, there is no federal law or guidance as to what stable coins should issue. Our firm publishes all our reserves. You can literally see the CUSIPs of treasuries backing our stable coins, but there's other stable coins out there issued from overseas that say they're worth $1. No one has any idea what's backing, right? So we do need federal regulation here, but ultimately, these are the three types of digital dollars that are out there. And in my view, that's actually a first use case, right? We all agree the dollar is currency, but how do we get that dollar and put it on blockchains? So with that, I will hand it over to talk about other types of cryptocurrencies.
Thank you. Also happy to be here. And like my friend, Dr. Tarbert, used to visit University of Maryland. I had one of my best friends went here when I was at Georgetown Hoya Saxa, and I used to come up to football games and spent way too many nights at Bentley's. But it is very fun to be back here today. So I'm going to talk about Bitcoin, which I think is the next topic that kind of flows from what my colleagues have already talked about. So so what is Bitcoin? So Bitcoin is a decentralized monetary network, which we've talked about. Some call it an alternative to fiat currency and central banking. Some might also call it a supplement or a complement to them, providing consumers optionality where you can transfer and store wealth outside the typical banking system that we're used to. It's been referred to as digital gold. In fact, Fidelity Investments has referred to it as exponential gold, a modern day commodity where you can store your value that might not be deflationary quite like the dollar, or inflationary quite like the dollar, where the value of one token is going to decrease over time. And finally, I'll touch on digital energy because Bitcoin mining data centers really secure the network, and they typically run on stranded or wasted energy, and they're turning that wasted energy into a commodity. So let's begin. Okay, so visualizing this, the decentralized network, on the one side, you see the Federal Reserve. I won't dive too deep into the Fed and the banking system because that's already been covered for us. The Bitcoin network, in contrast, is secured by nodes, by data centers all around the world, tens of thousands of them. the way I conceptualize it, sometimes for people who aren't deep into the tech of this, is I think of the traditional system as you're in class, your professor collects all your tests and has one answer key, and he's determining what's right and what's wrong on everybody's test. Maybe you've had a class where everybody puts their pencils down, time is up, and then you hand your tests around and everybody gets somebody else's test to grade. Sort of similar, except that it's with the Bitcoin network, it's a carbon copy of the ledger that exists simultaneously all around the world in thousands of places. The characteristics of it, I'll run through a few of them: permissionless and inclusive. Anybody can have access to the Bitcoin network with an internet connection. You don't need a bank account, which we've covered this. You'd be surprised at how many people around the world are not banked. And when Mike was administering the Paycheck Protection Program, we found that out. A lot of banks went first to the customers whose paperwork they already had. They could identify those people, they could prevent money laundering, they could prevent fraud. It was hard for people who didn't already have accounts established to get access to the program. Just a real life example of why financial inclusion is a real issue. It's transparent and pseudonymous. It's transparent. Anybody can see the code. It's open source. It is not anonymous. It's pseudonymous. People have numbered addresses on the network. This means that in recent examples, people have talked about, oh, the Bitcoin network is good for money laundering. Not really, not anymore, certainly. To use a very recent example that has been in the news, and obviously the tragedy that's been going on in the Middle East, Hamas, it was said, collected a lot of Bitcoin, a lot of cryptocurrency. Actually, in April of last year, they issued a press release to their followers saying, please stop donating to us because the Americans and the Israelis are able to follow the clues on the Bitcoin blockchain and figure out who our supporters are. They're able to track us down and they're seizing the Bitcoin. So it's the pseudonymous versus anonymous distinction is important. The authorities are still able to track things down. The Justice Department's gotten very good at it. They recovered a lot of the money that was used in the Colonial Pipeline hack, where they did a ransomware attack, collected Bitcoin. So the network, again, pseudonymous, not anonymous, and it's very transparent. It's permanent and secure. This is good in that a transaction can't be altered. Like Professor Faulkender said, you can't go into the network and change what you owe or what's in your account. You can't hack in and alter the records. Should also be careful if you're sending someone Bitcoin, that can't be reversed. So make sure they're not conning you out of your money. It is scarce. There will only ever be 21 million Bitcoin. That is baked into the code. It is a feature, not a bug, but it is transferable very quickly anywhere around the world. And finally, censor resistant and open source. So a very public example of the banking system being restricted and viewpoint discrimination occurring in real life. Very famous example was the truckers in Canada when they were protesting against vaccine mandates during COVID. They didn't think there should be mandates. So they started raising money on GoFundMe. They were doing protests, and the Canadian government didn't like that. They ended up shutting down those accounts, really defunding the groups. It's much harder. It's not impossible. It's much harder to do that with Bitcoin because, like I said, it's pseudonymous, censor resistant. So the government is not really able to drain your account. Okay, go on to the next. Okay, the next feature or way of thinking about Bitcoin, call it digital gold. The modern version of a scarce commodity. It takes a lot of energy, it takes a lot of time, it takes a lot of money to draw gold out of the ground. There's only so much of it that exists. Similarly, Bitcoin mining is expensive and time consuming and difficult. Bitcoin, like I said, there will only ever be 21 million, so it's a scarce asset. You talk about inflation. At this time, the US government is running $2 trillion deficits, about 40% or close to it of the budget is deficit spending. The government's printing a lot of money. Every time it prints more money than it's taking in, it's devaluing the value of that dollar. Now, maybe you get a raise to compensate for that over time. Maybe you don't. But as you can see, the value of a dollar over time keeps going down. But recently, since kind of Bitcoin started in the aftermath of the financial crisis of 08 and 09, the scarcity of Bitcoin has been one of its best attributes, and the value has gone up over time. Not without volatility, but it's gone up over time. Actually, if you look at charts of gold, it's sort of similar. And over the last 15, 20 years, the value of gold has gone up by about, 4 times. It's gone from about $500 an ounce to about $2,000 an ounce. If you look at charts of Bitcoin's value, it's sort of similarly volatile, but on an upward trajectory due to its commodity-like attributes, its scarcity. Like I said, it's only 21 million. The issuance schedule every 4 years is a halving. That means every time you're mining a new block, the number of rewards, the number of new Bitcoin that are issued are cut in half. Right now, it's 6.25. And then people are projecting that in April, the next halving will occur. That means the next block after the halving will only receive 3.125 Bitcoin. It's the number that will be issued. And then the final way of visualizing this is digital energy. Like I said, Bitcoin mines are very flexible. They can be turned on and off at a moment's notice because the network is decentralized, because there's computers all around the world that make sure the network exists, whether one data center is turned on or off. This makes them ideal customers for a lot of wasted and stranded energy. Solar and wind are 2 prime examples because there's a great deal generated in a state like Texas. That's where my company has our Bitcoin mines. But there aren't a lot of people that use that energy because over the course of the day, when the sun is shining and wind is blowing, that's not where peak demand is. It's actually when people get home at night, 4, 5, 6 o'clock at night, when the sun is going down, that they're turning on their air conditioners, they're turning on their heaters, they're turning on their TV and their lights, and you need more power. So these projects are difficult to make economical, but Bitcoin mines can do that because they can use energy when it's abundant and then turn off when it is more scarce. That's a view of part of what a Bitcoin mine looks like. As you can see, it's a computer data center, stacks on stacks of ASICs, just mining and hashing. Here's a graphical depiction of what I mean by digital energy. This was a winter storm in Texas in 2022. You can see the blue line is large flexible loads. That's Bitcoin mining data centers. And with the red line is the demand for power. So when it got really cold, people needed their power and the Bitcoin mines turned off. And when conditions normalized, the Bitcoin mines turned back on. Finally, a metaphor, I'm test driving this with you guys. I sometimes need to be able to explain how Bitcoin works to my parents or grandparents, or maybe people even older than them, like US senators. And so I'm test driving this. Has anybody seen National Treasure? Anybody, the Disney movie National Treasure? Okay, a few of you. So it's a treasure hunt. He has to find a map. He has to find different clues. He has to put them all together. He has to find the different clues that he was able to pick up along the way, put them into this keyhole, twist to the right degree, and then open the treasure room where all the value is stored. When Bitcoin miners are hashing, it's a series of letters and numbers, and each one is a clue, is a piece of the right key that's going to unlock a block that's going to be added to the blockchain. And the block has important data like timestamps, values, addresses, so that we can tell who owns this amount on this date. If they're sending it to a different address, how much are they sending, and so on and so forth. So when you get the right hash, the right sequence of letters and numbers, it unlocks the door to the treasure room, or in this case, adds a block to the blockchain and validates a series of transactions so that people know how much they own at what time in any given place. The final point I'll make is Mike talked about use cases, so did Heath. So Bitcoin is store of value, medium of exchange like other different types of money. Some of the most important use cases right now would be cross-border transactions, Americans sending remittances to other countries. I just spoke this week with a number of sort of political refugees from Russia and the Soviet bloc, Ukraine, who are not welcome in their banking system. They would be censored, or they would have their assets seized. They're using the Bitcoin network because it's harder for their oppressive regimes to get to their assets. So that's one of the most important use cases that I would point out right now. But why don't I stop there and we can get to some questions? Thank you.
Digging into the questions, and again, thank you for those of you in your registration for providing these. I tried to sequence them in some kind of logical order. But let's start with, what are the shortcomings of the existing system? You know, what problem are we trying to solve? And why do these digital platforms, why does the cryptocurrency solution, why does that solve those problems? So I think you guys pointed out some of them. There's financial inclusion is one of them. There's the time that it takes to do an international remittance. But what are some of the problems that we're trying to solve through this?
Well, I guess you mentioned international remittances. So how many people are either from abroad or have family abroad right now? All right, a good number, right? On average, when you send money overseas or money goes to you, even if you use one of the I'm not going to name names, but some of the big remittance firms or whatever, you're still paying what, 7-10%, maybe more? Yeah, 4%, right? So you're still paying 4%. That adds up. But effectively, there's no reason. Do you pay money when you send an email to them overseas? No, of course not, right? And the same is true with this system. So there's no reason you should be paying fractions, like either nothing or sort of basis points on that, not 400 basis points. So cost is a huge thing. And we're seeing that in some countries, people are charging 12-15%. The poorer, the more developing and fragile a country, the higher the remittance. So the people that need the money the most end up paying exorbitant fees. This, with blockchain technology, it effectively eliminates those fees. So I'll use that as an example, cost.
Yeah, one of the others that we discussed is inclusiveness. Many developing societies, people are underbanked. A lot of people are unbanked or underbanked here in the US. These things are accessible to anybody with an internet connection. And the other, the third element I would add is time. You know, setting aside international, yes, international transfers take days and multiple institutions and sometimes layers of fees. Even in the US, we can be at the mercy of bankers' hours. And I was just transferring money between two accounts that I control. And it took 24 to 72 hours to clear the transaction. I mean, there's really, in my opinion, no excuse for it to be this way. We've had the internet for a long time now where we can send information instantaneously. We should be able to send value instantaneously as well.
Now, I would add one more, which is the store of value. Here in the United States, most of you have bank accounts. Most of you have access to dollars. You've got Venmo, you've got Zelle, you've got that sort of stuff. But you go outside the United States, it's very difficult to get dollar-denominated bank accounts and to have a store of value against, in some cases, Argentina, a currency that is rapidly depreciating. Your life savings can be wiped out. So you may want to hold some of that in dollars, but it's very difficult to get physical dollars. You may want to hold some of that in digital assets like Bitcoin, which, you know, if you believe it's like digital gold, it's a hedge. And so I would say that in some ways, the need for digital assets we've seen is even greater in some ways outside the United States than inside the United States, because all things being equal, we've got drawbacks here, but our financial system is far better than those in other nations.
So we've talked about three of the explanations being speed, access, and cost. Another is, and I think, Heath, you mentioned it in your opening remarks, it's not a coincidence that Bitcoin got its start during the financial crisis. And so one of the other elements about, for instance, Brian, moving to a cryptocurrency is that dollars and stable coins are ultimately claims to dollar-denominated purchases. But the amount of dollars that's outstanding is a political decision determined by the Federal Reserve, and they can, if they'd like, alter the amount of currency that's outstanding, as opposed to a number of cryptocurrencies where the supply is not determined through the political process, it's determined by an algorithm, or it is determined at the onset of the creation of the cryptocurrency. So can Brian or Heath, Brian, we'll start with you. Can you talk about what are some of the benefits of moving towards an algorithmically determined supply of money?
Sure. So I will say, I don't think they're mutually exclusive. I mean, a dollar-based system or stable coins, they carry the trust of the government. People are comfortable with them. It is still the world, the dollar is still the world's reserve currency. Some of the benefits, though, of the algorithmic of a Bitcoin, I mean, its scarcity, I think, is probably its number one attribute because it is a hedge. If dollars are being printed out of control, then people have a comparative asset or a hedge to store their value so that they're not seeing it just drop and drop and drop. The sensor resistant piece, I come back to if you are worried about having assets taken away from you. I'm not talking about criminals or money launderers or anything else, but there are humanitarian reasons why you might want sensor resistant storage of value. That's another benefit. But I would come back to the primary thing being, we used to peg the dollar to gold. We got away from that. Formally or informally, I think we kind of have to be heading towards pegging the dollar to some kind of real world value, whether that's Bitcoin or a basket of commodities like Bitcoin and wheat and oil and beef and other things that people need in real life. It's supposed to reflect things that people need. It's supposed to reflect assets that take time and energy to create. Money and energy, in my opinion, are inextricably linked. So I think that an algorithm-based currency might actually help strengthen the dollar in some way. That's a little roundabout.
But you also mentioned, for instance, that places like Argentina, we've seen a pickup in the use of Bitcoin. And one of the things about Argentina is we did see the central bank flood their economy with currency when they got into a debt crisis, right? And so, and Heath, when you were at Treasury, you worked closely with the IMF, right? And so part of the challenges that you have when you have a central bank that is a political determination of the supply of money, in times of crisis, there is a political temptation, or in times of debt, for instance, there is a political temptation to seemingly solve the debt problem by printing money. But of course, money ultimately is a claim to commerce. And so if you've got more claims to commerce out there, it devalues the dollar. So again, kind of same question about, or your comments on that from your kind of IMF perspective as well.
Yeah, no, I think the fact that there are digital assets out there, both digital assets that are unique to the digital asset system, like Bitcoin, Ether, things like that, as well as the availability of digital dollars, I think helps discipline the central banks of other countries because their citizens now have a choice. Now, the interesting thing, though, is the real question is, well, if it is algorithmically determined and in fact it's scarce, well, those are things that actually make it less likely to be a currency, right? Because if Bitcoin is going up and up and up, who here is going to buy a pizza with Bitcoin, right? You want to hold on to that Bitcoin. If it's like gold, you don't go out and you buy a cup of coffee from Starbucks with gold, you hold on to the gold, right? So there's also this inverse economic relationship between how scarce it is. And so you may use it for certain things. You may buy Bitcoin, hold on to it, flip it into other investments, but you may not use it for daily transactions, right? So I think you're going to also see sort of a stratified approach to digital assets where you're going to see fiat-based digital currencies, as well as some of the more unique indigenous digital currencies to the system.
And to that point, I think it depends a lot on the circumstances. I mean, El Salvador was experiencing hyperinflation. They made Bitcoin an alternative legal tender in that country. When you go there, you can pay for pizza in Bitcoin, and in other places you can. But you're right. If we're talking about the competing systems of a devalued currency, or if, like, I think Argentina is going through, some austerity measures following their election, there will probably be less government spending. Maybe their currency will come back in line, and with the competition of Bitcoin, maybe that's a healthy thing, and people will be able to choose depending on their circumstances whether they want to use fiat or a cryptocurrency.
So Heath, you mentioned that you see perhaps there being kind of multiple currencies or multiple items that we store. So help me understand, should I think 5-10 years from now that I am going to see prices quoted at the grocery store in both dollars and in a cryptocurrency? Or am I going to pay for things? Am I going to pay my credit card in Bitcoin? Or help me understand where you see, or where Circle sees, the evolution of the payment system going, and how this is going to displace the way that we currently transact.
So big picture, I think we've seen in every major, and the business school has done a great job looking at these various industries, we've seen kind of a merger of the internet and sectors across the board, right? Where the internet, whether it's consumer, whether depending on the sector, we've seen kind of a merger of the internet and that sector. The financial system, we haven't yet seen that wholesale merger, because the financial system is closed, it's heavily regulated. But ultimately, the internet and the financial system will grow closer together, and what makes that possible is blockchain. So what I really think you're going to see is, for Web3 projects and the integration, you're going to see, you know, various tokens being issued by the various products. They'll start to become worth something. You may buy those with digital assets, but I'm not sure day to day. I still think, my own personal view is, for day-to-day transactions, the dollar will still be, unless we have just a complete loss of trust. And you may argue we're getting there or along that road, but unless we see a complete loss of trust, I still think the dollar will be the main currency that people transact in. But people may keep a lot less of it on hand, right? You may take that dollar and immediately try to convert it into an interest-earning asset. You could do that through DeFi, or you may want to convert it into some other kind of digital asset if you think the dollar continues to lose value. But I see a situation, unless the government itself says, like they did in El Salvador, these types of digital assets are also legal tender, I still see the dollar being the predominant payment mechanism in the US.
So Brian, to the extent that we're going to use Bitcoin to buy something, you know, and again, I'm not a Bitcoin user, so help me out with this. My understanding is that the blockchain gets updated like every 10 minutes, but when I go to the grocery store, or when I go to a department store and I purchase something with my credit card, you know, it's about a 1-second time frame for that transaction to be approved. Help us understand, like, are we going to wait around for 10 minutes while this purchase gets added to the blockchain before the merchant allows me to leave with that merchandise, or how does that all work?
No, now there are some great innovative companies. One is Cash App, Jack Dorsey, the former CEO of Twitter, runs. Strike app, which is a very young innovator named Jack Mallers. They are useful for instantaneous small transactions, like your everyday transactions. I was just at a coffee shop in Nashville where you can only pay in Bitcoin, and they accept that Strike or Cash App will work there. So it's getting there. I don't disagree with Heath that I think the day-to-day transactions in US dollars are likely to continue. Maybe the biggest Bitcoin bull on planet Earth is a CEO named Michael Saylor, and his company, MicroStrategies, owns more Bitcoin than anybody else, I think, aside from Satoshi. But he says, I don't think Bitcoin is a competitor to the US dollar. I think it could help, you know, in a stabilizing way. On the previous question on technology and blockchain and where we're going, there are already municipalities and counties around the country, California, New Jersey, I know for sure, are putting real estate title on blockchain. I mean, could you imagine a county clerk's office with everybody's deeds in the county burning down and all the records disappearing? So it's becoming a matter of just a way of life and security, that things are going to be sort of, you know, tokenized or securitized on blockchains, because it's getting to the point where it's not going to make sense not to. Right?
And I would just, you asked the specific question, transaction time. Do you have to wait 10 minutes for the Bitcoin? So the answer there is, there are new blockchains that are much faster. So Bitcoin will always be Bitcoin. So and that's what we call layer 1 blockchain, sort of the basic blockchain. There are new layer 1 blockchains that are much quicker, but there's also things called layer 2s, which are overlay the original blockchain.
Yes.
And are able to do transactions, like millions of transactions in the fraction of a second. They are all sorted, and then ultimately they are then put on the layer 1 blockchain and recorded as a block. So it's almost like a batching system that lies on top of the layer one blockchain. So companies are developing those, and those are speeding up things really fast.
The Lightning Network is the one that is most useful, at least for Bitcoin. And I'm focused on Bitcoin because our company is a Bitcoin only company, and because it's the biggest and kind of the OG of digital assets. Obviously, there's a lot out there, but that's kind of where my expertise lies.
So Heath, another thing in your opening remarks that you mentioned is that we have not updated legislation and regulation with regards to how the supervision of these assets and this space. And so, an open question that emerges is, are these technologies securities or are they commodities? Should they be regulated by the CFTC, the Commodity Future Trading Commission, of which you were the chair? Should they instead be overseen by the Securities and Exchange Commission? Should they be under the guise of the Federal Reserve? Where, putting back your CFTC hat, what should the regulatory architecture look like?
So at a high level, first of all, I would not create some new federal agency. We've got so many federal agencies. So I don't think we need another federal agency. At a very high level, here's what I think. Number one, I think there are things that are basically money, payment mechanisms. So I would put stable coins, dollar-denominated stable coins, provided they are backed by dollar-denominated safe assets. I would call those a monetary instrument, the equivalent of cash, and I would have them regulated effectively by the Fed and the payment system regulators. I would make them part of the payment system. Then you have other digital assets. And the key question would be, is the price and value of that digital asset based upon just more generally supply and demand in the market? Or are they based upon the people that created that digital asset and the efforts that they're doing to continue to prop up that digital asset? That's really the distinction at a very high level, a non-legalistic level between a security and a commodity. If the thing is out there and it's in and of itself and it's just sort of supply and demand like gold or wheat, it's a commodity. Bitcoin is a commodity. If it's a coin or a token that has been created by a company, and if those founders of the company and the people working in the company, if they were to go away, the thing would collapse, and you're relying on them and their constant efforts, then it's a security. You're investing in that common enterprise. So that's where the line should be drawn, in my view. So basically, some things are commodities, some things are securities, some things are payment mechanisms.
And so, Brian, where are some areas that are just calling out for regulation? So as we think about the components being done by the Fed, by the CFTC, and the SEC, what are some places from your perspective that we really need some clarity, either from the regulators or from Congress?
So that clarity that Heath just articulated should be in legislation, for starters. Secondly, I mean, there's other areas that are touched on by what we do. For example, the tax system. So Bitcoin being a commodity, I think should be taxed like a commodity. So if you're drawing oil out of the ground or you're mining gold out of the mountain, that's generally taxed when you sell it. But currently there's no legislation. So the IRS just kind of guessed and issued a notice and said that they're going to regulate it where when you mine it, you're taxed on that as income. And then when you sell it, you're selling an asset. So there's another instance. There's a lot of discussion of AML, KYC, any money laundering rules. I actually think where the regulators have landed so far, which is to basically say if they can identify an address of a bad guy and they can prove that it's a bad guy and they're misusing those funds, they can essentially sanction that person. I think that makes some sense. There's some other proposals I think that make less sense or no sense, where they want to be able to sanction nodes or entire networks if a small portion of that population is misusing something. So those are a couple of the other areas that I think are crying out for some clarity from the federal government.
And I'll just say on the stablecoin issue in particular, we have a situation where the US has fallen behind. Other countries now, the European Union. The European Union is generally not known for being innovative and ahead of things, vis-a-vis entrepreneurship and things like that. But they've taken this to heart. They've said digital assets are here, and they've created a comprehensive regulatory framework. That framework actually spells out what a digital dollar should look like. Other countries like Japan have finalized their regulations, Singapore. So we have this very bizarre situation where other countries are essentially regulating what should a digital dollar be, and our own country hasn't, right? And so it's really important that we get some kind of federal legislation to also even the playing field. So they're like, if you're going to issue something and say it's worth $1, here's what needs to happen. It needs to be backed, 1 for 1 with safe dollar denominated assets. You need to be supervised by a state or federal regulator. You need to comply with AML, CTF law. None of those things are mandated at the federal level at this point. And it's a real risk for consumers out there because they're, like I said, all stable coins aren't stable, right? Some are more stable than others and some aren't stable at all. But yet here they are and they're floating around. So we do need a uniform system.
So one of the other areas where there's been some discussion about potential regulatory needs is in the area of consumer protection, right? So again, for those of you that haven't really lived in the regulatory space, there's kind of two tensions that are at play. On the one hand, there's this notion of caveat emptor, which means buyer beware, that people just need to recognize that they're engaging in a risky activity and that they need to take personal responsibility for the activities in which they're engaging. On the other hand, there is still this notion of paternalism that sometimes people need to be protected from themselves and also from other bad actors. And so our regulatory system is kind of this series of trade-offs that we make between granting people access to risky activities, but nevertheless putting safeguards in place so that people who perhaps don't know any better aren't too much taken advantage of. So where do you guys see the needs for some notion of consumer financial protection, whether that's done by the CFPB or that's done by legislation? What are the consumer protection needs that you think exist in this space?
I would start with where I think it's somewhere around 95% of the market is right now, which is with exchanges, and kind of formalizing the fact that they act a lot like traditional financial institutions, and they often will do AML. Okay, they know your customer, they know who you are, and they're supposed to be backing up the assets they're holding for you. Of course, the famous collapse of FTX, they were offshore. They were not subject to various regulations. They were commingling funds and things like that. So, an example of a mechanism would be proof of reserves. Like he just talked about, if an exchange is holding assets in your name, they have to actually have those assets there, unlike a fractional banking system. So I would look first to the exchanges for some, what I think should be fairly easily implemented consumer protection laws, and that would cover the vast majority of the market of digital asset holders, and then move to the more nuanced pieces after that.
Yeah, so Heath, it does seem like one of the issues in this space is that there are all of these mistakes that we learned from prior to the Great, with the bank failures in the Great Depression, the blue sky laws, for instance, that were issued in the securities spaces. And so how much of it is there's actually something fundamentally different going on in this space versus we just need to update things because a lot of what's happening in the digital dollar space or in the stablecoin space is kind of 100-year-old banking that has new labels for which we've not updated things.
Yeah, I would say the fundamentals don't need to be updated because human nature hasn't changed. Fraud is fraud. Anytime there's a new technology, something, whether it's a railroads or anything else, there's going to be fraudsters, there's going to be tricksters, there's going to be gimmicks. We saw it with the internet bubble, and now we're seeing it. There's been a lot of fraud in the digital asset space. There's no question about it. There's been a lot of schemes to defraud effectively. So I think all of that needs to be there. You need to hold those people accountable. I do think in the very technical regulations as to how things work mechanically and operationally, our regulations need to be updated to reflect the new technology. So I would say it's a blending of the old and the new, but I think we all need to be able to just realize, like, human nature doesn't change. So anything that happened back, before in the 30s, in the great financial crisis, it's probably going to show up in one form or another today with the technology. So let's not be naive about that. But at the same time, we do need to update our plumbing and the regulations related to it.
So another area where the plumbing is being updated is that the Federal Reserve is coming out with the new FedNow system. We're moving. So right now, the way that the banking system operates, for those of you that are not familiar, is really the things clear 5 times a week, right? So overnight, during the weekdays, that's when clearing takes place. There's been this argument that we ought to move to real-time clearing, right? So rather than waiting for that check to clear or for that deposit to actually become available to me, as it has to take overnight for that to happen, that it really should be happening instantaneously. Does the FedNow system that's being operated change anything in the digital payment space, in the crypto space? Is the evolution of the crypto space kind of finally forcing the Federal Reserve and the government to update some of the outdated plumbing? What are your thoughts on the actions of the Federal Reserve in this?
I haven't seen a measurable effect on a permissionless, system like the Bitcoin network. I think they're getting much needed pressure to catch up. I don't think they ever will. I don't think they're capable of actually catching up to the private sector and some of the innovators that are really successful today. I think it's improving things broadly. It's not really impacting, for example, the Bitcoin network.
Yeah, I would agree. I mean, it's great that the Fed is moving forward and things are getting faster on the back end. But remember, these are sort of wholesale networks among the banks themselves. And basically what they're doing is taking a infrastructure that still has the remnants of the 1970s and 80s and just sort of making it a little bit better, speeding it up. So it doesn't fundamentally change the way. It's still a very centralized ledger-based system. And so it's not the kind of radical departure and the embracing of the massive computer technology that is, the decentralized financial system through blockchains.
Okay, so on the one hand, we have the integration of the payment system and the banking system with digital assets. There's also the co-integration between like equity markets and other financial markets and the cryptocurrency space. What do you foresee? Do you have any concerns about there being contagion between crypto markets and equity markets, or do they actually serve as hedges for each other, or do you worry at all about any challenges in the digital asset space carrying over to, for instance, equity markets?
I would say so. I think they're going to diverge more over time. I think given the newness of these assets, and I mean, Bitcoin is created after the financial crisis. It's still only 15 years old. And most Americans are still now just learning about it. And so it has been mostly a invested asset with a small amount, low risk investments for people in America, just generally speaking. And so the value has at times kind of tracked the market. As people have more disposable or investable income, the value has tended to rise a little bit. I think they will tend to diverge over time when people learn more about how they're really different assets than just a stock or a bond or something like that. So they've kind of tracked in patterns so far, but I think they're going to diverge as people learn more. That's my take.
So I think our audience is starting to get eager to participate.
Let's do it.
And that was actually Bruce's question. So Bruce, it looks like you've got a follow-up on that. So do you mind using the microphone since we are recording?
What about Bitcoin ETFs? How does that factor into the answer that you just gave? And also, what are your thoughts about that connection between those two worlds?
Sure. So Bitcoin ETFs offer an opportunity for your traditional investor to gain access, to gain exposure to it, put it in their portfolio at whatever amount their investor advisor recommends. This will lead to more mass adoption. When BlackRock starts backing an ETF with Bitcoin, that is going to increase the demand for it. I mentioned the halving and the limited issuance coming in the near future. That means supply is going to be lower. When you have more demand, less supply, the price will probably go up. That's number one. That's a prediction. I didn't make up that prediction. That is shared by many analysts across the financial space. I think in terms of the long-term effects, I mentioned the store of value, people treating it like kind of a digital gold, like a scarce commodity where they want to put their money, maybe not in dollars. If inflation is really high, they want to have a hedge. I think that sort of activity, that kind of thinking, investment thinking will probably grow more and more, particularly with the dynamics that I just outlined. And I think the only other layer I would add in is what we've already discussed, which is perhaps we'll have this kind of competition between a scarce asset and dollars that are being printed at an excessive rate. And maybe that kind of pressure is going to lead to better monetary policy or more value in a dollar. Those are my thoughts. Did I address your question? I want to make sure I actually answer your question.
Hello, my name is my two questions for Morgenstern. My first question revolves.
I think she's going to turn on the microphone for you.
I'll start over. My name is Joseph, and I have two questions for Mr. Morgenstern and Riot Platforms. My first question revolves around the fact that the credit market is fundamental to any modern economy. Do you see the rise of a Bitcoin credit market? If so, what are the steps to get there? And is Riot positioning themselves to be a pseudo bank?
So I would say to the second question, no, because we're not a company that custodies people's assets. We are the miners. We're the generators of the Bitcoin. We are securing the network. We're more like a software provider than a bank. So to that question, I would say no. Bitcoin miners are more likely to become energy generating companies because our biggest input is power. We're looking for the lowest cost power. And if you're trying to vertically integrate a company, the last piece of risk that you can mitigate is where's your power coming from? So I think Bitcoin miners are more likely to become power companies than banks. In terms of a Bitcoin credit market, there are some digital assets where people will stake. I know Coinbase keeps telling me to buy USDC and get a 5% interest rate back on it. I'm not ready to say that, yes, Bitcoin will be involved in credit markets anytime soon, but I would say it's not impossible. But it wouldn't be a company like ours that does it.
Gotcha. So my second question kind of goes with the energy topic. With chip usage and digitalization becoming fundamental to society, do you see the possibility of an electricity crisis? And how could we as a country overcome an electricity crisis?
So our power, we need more power, not for Bitcoin mining, for everybody. We need more power. We're wasting, I think the majority of power that's generated is lost because it's either lost in an inefficient generation process, inefficient transmission processes, or like in the wind and solar examples I gave, we don't yet have good battery technology, storage technology to be able to use all that power. It's often generated and then there's nobody to offtake it. With the proliferation of not just Bitcoin data centers, AI data centers, really the economy of the future, we're going to need more and more electricity. It's going to have to be generated somehow. Some of the cleaner sources, at least on the environmental side, natural gas is pretty clean burning, nuclear is clean. I think the US is going to have to get more heavily back in those businesses because I think our economy of the future is going to demand it.
Okay. My question is to Mr. Heath. I have been utilizing USDC, USDT, as well as Terra coin. Terra fell down with the Terra coin, and USDT had a Hindenburg report against it. Your firm had invested 8% of its value in SVB, and I remember a few years back, it like unpegged by 87 cents to $1. Now, how can I, as a user, can be sure that there won't be any bank run, USDC will be protected because there is no FDIC which is protecting you?
Yep, great question. So first of all, Terra Luna, that was what we call an algorithmic stablecoin. There was nothing backing it whatsoever except with mathematical formulas. So that was definitely a buyer beware. USDT, I have very strong opinions on them, but they don't have the kind of transparency and things. You don't know what's backing them. In our situation, we actually never lost the peg, Circle. At any point in time, Circle customers could redeem for one for the US dollar. But with the crash of SVB, we had money, and this was part of the irony of this, is that Circle has about 93% of our reserves in a reserve fund that's managed by BlackRock called the USDC Reserve. We also have money in banks, and we had these in various banks. It was a situation where crypto didn't hurt the banking sector. The banking sector hurt crypto. So what happened was, and we were very transparent. So they saw that we had 3 billion of our reserves in SVB. So the markets reacted saying, oh no, like Circle has money. At no point, however, did Circle say, we're not gonna honor it. At every point in time, we were doing $1 for $1. So there was this couple of hours where USDC went down. If you had held on to your USDC, it would have gone right back up to $1 again. But there was a scare in the market. I think one of the things that can affect that and ameliorate that is the federal legislation that I mentioned. If you know that Circle and firms like us are out there, we're registered with and we're regulated by the New York Department of Financial Institutions now. But if there was a uniform federal law that everyone had confidence, these guys are being looked at, they're being watched. And if we didn't have to put our money, for example, in commercial banks, we could just put it at the Fed. Those sorts of things wouldn't happen. But that's part of it, is that the ecosystem, and one of our big concerns is some of these other stable coins, like a Terra Luna or something like that, could end up, if they collapse, creating a problem for a firm like ours who has everything one back for back. But again, that was in the secondary market. And Circle always honored the one for one. And so we came out and basically said, look, we don't know what's going on in those trading markets, but we're telling you, we are still honoring one for one redemptions, and we have our own balance sheet to back it up. And then the price went back up again.
Thank you.
Yep.
Hi, thanks for the amazing talk. I have a question that I would like to hear your view about is, what do you think would be the effect of this decentralized Bitcoins and also the spreading of it on the monetary policy? And is that something that the central bank should be worried about?
Worried about, no. Like I said, I and many others who recognize the value of Bitcoin don't necessarily think it needs to compete with the dollar. It can be an alternative asset that people hold. Maybe they exchange value in that way, depending on the circumstance. But as an American, I like to see the dollar be the reserve currency. I like to people, like the example that Heath gave, perhaps people would store their money in any number of assets, stocks, bonds, Bitcoin, gold, whatever it may be. And then if they want something, as a hedge against inflation, and then convert it to dollars to spend, that's certainly a perfectly reasonable possibility. The Fed did, and the other bank regulators did scare people in January of 2023, when they issued a notice saying that digital assets can be threats to the safety and soundness of banks, which kind of shocked people and scared people. And that was the banking system having a bad effect on digital assets. That's another example. And for example, our company has hundreds of millions of US dollars where they're running payroll for our hundreds of employees that are engineers, and they're software developers, and they've all these different jobs. And when the bank regulators did that, banks got scared to even hold our deposits with payroll in US dollars. So I would urge the regulators to use caution. Don't view us as a threat, view us as an alternative asset that people can hold and use as they see fit.
Thanks.
Please.
Hi. So my question is more on the use by the general public. So like, one of the major reasons why it's not getting accepted a lot amongst merchants is because of its volatility, right? So if that's, and it said that when more users get onboarded, it might reduce. So, but then if there's this constant cycle which doesn't break because people are not ready to accept it because of its volatility, and then the normal people will not want to get into it because merchants are not accepting it. So how does that break? Unless something like you stated about El Salvador, something like that coming into effect, that doesn't really happen. So in spite of its advantages, how does it reach like on a day-to-day basis so that, yeah, it can be used?
Well, one way is what we discussed with the ETFs. When you have institutional adoption and then you have tens of millions of consumer adoption, you're going to have price discovery, which is going to lead to more stability. And if you put it on parity with gold as an asset, then it should, again, theoretically, I don't know if this will happen. Some people are confident that it will. Hopefully it will. If it becomes on parity with gold, then you're looking at about $600,000 per Bitcoin. And then perhaps it's at that level, like I said, of a store of value, of a scarce commodity, others that exist in the market where the price has truly been discovered. I think it's going to take time and more adoption, and then there will be more certainty.
Thank you.
Hi, my name is Mitt. So the question that I have, it's very intriguing how Bitcoin can be used as a alternative currency. They talk about using it as an alternative currency versus a hedging asset. Particularly, I'm not sure if you guys have seen secondary funds such as the Blackstone Infrastructure Fund recently announced many investor redemptions of their assets, particularly because commercial real estate markets had been on a downslide. And this produced a very big liquidity risk management problem, particularly that the fund had to sell many of its high value underlying assets, resulting in that fire sale of assets to really meet with these investor redemptions. So kind of seeing that within the secondary market, do you see Bitcoin or any type of cryptocurrency as being a tool to use for alternative liquidity management along with the dollar? Or how do you see Bitcoin really addressing that liquidity risk management, given the fact that Bitcoin really, there's a finite supply of Bitcoin, and on top of that, mining process and everything it's a very long process. So how do you see that as being used for liquidity?
It is one of the more liquid assets you can hold at this point. I mean, liquid assets comprise what? Bank deposits, stocks, bonds, things you can convert to cash fairly rapidly. I think you can include Bitcoin in that category. I could right now on my phone go on Strike or River or Coinbase or any number of other apps and pretty quickly convert Bitcoin holdings into US dollars, if that's your question. So I want to make sure I understand it, but I think the answer is yes, it could be used in that way. And perhaps some of the larger institutions will use it in that way.
And my second question is, in terms of high frequency trading, you had mentioned the time gap between mining and the transaction system. So how susceptible is the Bitcoin network or any type of blockchain network to high frequency trading, and how can you potentially mitigate that?
I mean, I've worked at a trading firm. I mean, I think the high frequency trading, and that's sort of a misnomer. Some of it's sort of algorithmic, some of it's not, some of it's low frequency trading. Some of the algorithms are designed such that they only may be tapped once or twice a day. They normally make a decent amount of money on those trades, but it's, you know, it's sort of a misnomer to think about like just all these things shooting to exchanges all the time. But remember, much of that high frequency trading is occurring on the secondary markets, on the exchanges, not on the underlying Bitcoin network and wallets. And so most the way that sort of works is, to the extent you've got a active trading secondary market, That's occurring on the exchange. The exchange will settle all of that at the end of the day in some cases, and then it'll be, stamped on the blockchain. So that's the way that the two would be integrated, I think, in real life.
Thank
That
you.
makes sense.
Yep.
Yeah.
All right, well, with that, we're approaching 7:30. So please help me thank our guests for joining us. It's great to have two of my former Treasury colleagues out to help us understand these really innovative technologies that are happening. Please also pay attention and join us on April 2nd. We're going to have two additional experts come out and talk about student loan forgiveness in the third of our series. So thank you for joining us and good night.